Most people missed what happened in the gold market last month. It wasn't on the front page of the Wall Street Journal. It didn't trend on financial Twitter. There was no dramatic press conference or emergency announcement. Instead, a handful of central banks quietly purchased more gold in a single quarter than they have at any point in the last 50 years. And the institutions that track this behavior, the ones with direct access to settlement data and vault records, they aren't talking about it on television. They're writing internal memos, they're adjusting their own positions, and they're doing it with an urgency that should concern anyone paying attention. This isn't panic, it's a pattern. And once you understand what it means, you start to see why the next phase of this financial cycle may look very different from anything we've experienced in our lifetimes. To understand why institutions are behaving this way, you have to understand the environment they're operating in. Because what's happening right now isn't a single crisis. It's a convergence of structural pressures that haven't aligned like this since the 1970s. Start with interest rates. The Federal Reserve spent over a decade keeping rates near zero, flooding the financial system with cheap liquidity to prevent a deflationary collapse after 2008. When inflation finally arrived in 2021 and 2022, they were forced to raise rates faster than at any point in modern history. That created a problem they still haven't solved. Higher rates didn't just slow inflation, they detonated parts of the banking system that had grown dependent on low rates. We saw it with Silicon Valley Bank. We saw it with Credit Suisse. We saw it with regional banks across the country that were sitting on unrealized losses so large they couldn't survive a modest wave of withdrawals. That was supposed to be contained. That's what we were told. Emergency lending facilities were created. The Federal Reserve opened discount windows and offered liquidity backstops. The message was clear, everything is fine. The system is sound. But if that were true, the behavior of central banks wouldn't make sense. Institutions don't accumulate hard assets at record pace when they believe the financial architecture is stable. They do it when they suspect the opposite. Now layer in the fiscal picture. The United States government is running trillion-dollar deficits during what is technically an economic expansion. This isn't wartime spending, this isn't emergency stimulus, this is structural. Mandatory outlays, Social Security, Medicare, interest on the debt. These now consume nearly the entire federal budget. Every new dollar of discretionary spending requires new borrowing. And the interest on that borrowing is compounding faster than anyone in Washington wants to admit. When you look at the projections from the Congressional Budget Office, you see something remarkable. Within the next decade, interest payments alone will exceed spending on national defense. That's not a political talking point. That's the baseline forecast, assuming no recession, no new wars, no additional emergencies. In other words, the best case scenario still leads to a place where the government is spending more to service its past than to invest in its future. This is the macro context. This is the environment in which gold just broke to all-time highs while most retail investors were focused on technology stocks and cryptocurrency speculation. The smart money isn't watching the same screen you are. So where is the pressure actually building? This is where it gets interesting. Because the stress isn't always visible in asset prices. Sometimes it shows up in the rules. Sometimes it shows up in the quiet administrative decisions that don't make headlines but reshape the landscape entirely. Consider what's been happening in the gold and silver derivatives markets. For years, the price of these metals has been heavily influenced by paper contracts traded on exchanges like the COMEX. These contracts allow institutions to buy and sell claims on gold and silver without ever taking physical delivery. In theory, this creates liquidity and price discovery. In practice, it creates a system where the price can be influenced by entities that have no intention of ever holding the metal. But something is shifting. The volume of physical delivery requests has been rising. In silver especially, the registered inventories at major exchanges have been declining steadily. What this means is that more participants are choosing to take real metal off the exchange rather than roll their contracts forward. This behavior is unusual. It suggests a growing distrust in the paper system, a belief that holding a claim on metal is not the same as holding the metal itself. At the same time, premiums on physical silver, the price you pay above the spot price to actually acquire the metal, have remained elevated. During periods of calm, these premiums are minimal. When they spike and stay elevated, it indicates that physical supply is tight relative to demand. The spot price might say one thing, the reality at the dealer level says something else. This divergence between paper prices and physical availability is one of the clearest signals that stress is building beneath the surface. And it's not just retail buyers noticing. Sovereign wealth funds, central banks, and large family offices have been increasing their allocations to physical metal, often through private transactions that never appear on public exchange data. Now, let's talk about what gold and silver are actually telling us. These aren't just commodities, they aren't speculative instruments. Historically, precious metals have served as a barometer for confidence in the monetary system itself. When institutions trust the currency, when they trust the credit system, when they believe the rules will remain stable, they have no need for gold. It pays no yield, generates no earnings. In a functioning system, it's a relic. But when confidence begins to erode, gold becomes something else. It becomes insurance. It becomes a form of money that exists outside the banking system, outside the reach of policy decisions, outside the counterparty risk that infects every other asset on a balance sheet. What we're seeing now is not speculative enthusiasm for gold. There's no mania, there's no retail frenzy. Instead, the accumulation is methodical, institutional, and largely invisible. Central banks in China, Russia, India, Turkey, and a growing list of others have been adding to their reserves consistently. They're not doing this because they expect the price to go up next quarter. They're doing it because they're repositioning for a different kind of world. This is the signal that most Western investors are missing. They look at gold and see an old asset that doesn't fit their portfolio models. The institutions on the other side of the world look at gold and see the only asset that doesn't carry the signature of another nation's central bank. Silver tells a related but distinct story. It's a smaller market, more volatile, more influenced by industrial demand, but it also has a monetary history that stretches back thousands of years. In periods of systemic stress, silver tends to follow gold, often with a lag and then with greater amplitude. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still historically elevated. Some analysts interpret this as silver being undervalued relative to gold. Others see it as a sign that the market hasn't yet fully priced in the stress that gold is already reflecting. Either way, the message is the same. These metals don't move in a vacuum. They respond to pressure, and right now they're responding. To put this in perspective, it helps to look at history, not to predict the future, but to recognize patterns. In the 1970s, the United States faced a similar convergence of pressures. Inflation was rising, confidence in the dollar was falling, the government had accumulated debts from the Vietnam War and domestic spending programs. The Bretton Woods system, which had tied the dollar to gold, collapsed. And in the decade that followed, gold rose from $35 an ounce to over $800. That wasn't a bubble, it was a repricing. The market was recognizing that the monetary system had fundamentally changed. The promises embedded in the old system could no longer be kept, and gold became the vehicle through which that reality was expressed. We are not in the same situation today. The context is different, the players are different, and the structure of the global financial system has evolved. But the underlying dynamic is similar. There's more debt than can ever be repaid in real terms. There is more currency in circulation than the productive economy can absorb without inflation. And there is a growing recognition among those who manage serious capital that the rules are being rewritten in real time. So, what comes next? This is where we have to be careful. Anyone who tells you they know exactly what will happen is either lying or selling something. The future is not a script. It's a range of possibilities, some more likely than others, but none guaranteed. One scenario is that the Federal Reserve manages to engineer a soft landing. Inflation comes down without a severe recession. Interest rates stabilize. The banking system absorbs its losses gradually. The dollar remains the dominant global reserve currency, and the pressure on gold and silver dissipates. This is the optimistic case. It requires a lot of things to go right and a fair amount of luck. Another scenario is that the stress continues to build. The government keeps running deficits. The Fed is forced to cut rates not because inflation is defeated, but because the financial system can't handle high rates. Liquidity re-enters the market, but this time with higher inflation expectations baked in. Gold and silver continue to rise, not in a mania, but in a slow grind that reflects eroding confidence. This is the muddling through case. It's not a collapse, it's a decay. A third scenario is more disruptive. A major credit event, a sovereign default somewhere in the world, a derivative blowup, a sudden loss of confidence in a major currency triggers a cascade. In that environment, the demand for hard assets spikes. Physical gold and silver become difficult to acquire at any price. The paper markets seize up, central banks intervene in ways that were previously unthinkable. This is the tail risk scenario. It's not the most likely outcome, but it's not as remote as it once was. The point isn't to predict which scenario unfolds. The point is to recognize that all of them involve metals playing a more prominent role than they have in decades. Whether the path is smooth or chaotic, the direction of institutional behavior is clear. As we close, it's worth stepping back and considering what all of this means for someone watching this video. This is not about making a trade. It's not about timing the market. It's about understanding the environment you're operating in. The financial system is more fragile than it appears. The institutions responsible for maintaining it are quietly adjusting their own positions in ways that suggest they know this. The signals are there if you look. Gold breaking to new highs, central banks accumulating at record pace, physical premiums remaining elevated, derivative markets showing signs of strain. None of this means you should panic. Panic is never a strategy, but awareness is. Understanding what's happening beneath the surface allows you to make informed decisions, to think clearly when others are reacting emotionally, and to position yourself in a way that aligns with reality rather than wishful thinking. The system will not send you a notification when the rules change. It will not issue a press release when confidence shifts. These things happen gradually, then suddenly, and by the time they're obvious to everyone, the opportunity to act has usually passed. So pay attention, read the signals, And remember that the most important developments are often the ones that don't make the evening news.